July 30th, 2022. I want to address the current situation, which is the basic announcement of that we're now in a recession. At least that interpreted according to classical understanding, with two successive quarters of negative GDP growth. That's defined as a recession under normal thinking, not under Biden administration thinking, but as we know, they have a problem with a thing called the truth. So, and we had 1.6% negative in the first quarter and a preliminary negative 0.9% in the second quarter here, which is reported on Thursday. Back in early July, I did another video where I kind of addressed this as a coming up issue, and I was uncertain whether we're going to actually hit recession or not, but we have. And I think that with the ongoing Fed tightening policy, it's unlikely that the situation is going to improve much. Now, what the actual refinements on the second quarter number will be, it's still up in the air, but but that's kind of the situation. The other thing that developed, of course, was that the day before, the Federal Reserve Board increased the Fed funds rate by 0.75 of a point, pushing us up to the 2.25 to 2.5 range, which they're calling neutral. So that's the level they want to get back to once they quit tightening. That's their objective if they're in when they're not trying to manipulate the economy. That's kind of the level they want to be at, which kind of fits the idea of around a 2% inflation rate is kind of a norm that they kind of accept. So your money is always shrinking in value no matter what, but there's a lot of issues around that. We won't get into that kind of stuff here. But, and by the way, again, please, if you haven't subscribed already, please do. If you have, give me a like. It helps out with the algorithm. You can forward these links to these videos to anybody you think might want to see them. And of course, comments are appreciated as always. So that's where we are. And of course, as I said in my previous video in early July, that this is a bit paradoxical in the way it will look, and that's, of course, what the administration is seizing on. The fact that there are so many unfilled jobs, particularly in the lower, let's say, lower income ranges, lower skill ranges, things like, working at fast foods or working at, which in some areas they're having trouble keeping open. Waiters and waitresses at restaurants and etc., that kind of thing. Those jobs will be readily available throughout this period, and that's what will give us somewhat positive sounding job numbers. The jobs that represent more of the bigger industry jobs, I think that's where you're going to see layoffs and cutbacks. So it's going to be kind of an asymmetrical economy in that sense. Actually, in this time, it's going to be kind of good for the poorer folk and not as good for the more well-to-do, that is, that are in the working workforce, not the people who just have a lot of money or something. So anyhow, that's kind of the situation we're in, and I think it's, of course, really amazing how the administration spokespeople are all just running around denying it's a recession and doing all this sort of. This is almost unprecedented, I think, as before this administration. This is they've really adopted the full Orwellian approach to politics. Reality is what the party says it is. If they say 2 + 2 equals 5, then it equals 5. That's the sort of thing we're faced with there. So that's where we are on that. And as I say, going forward, one can expect that the Fed will continue to tighten because the inflation index that they use, I think it's called was it PCE or something like that. At any rate, it came out at 6.8%. And that basically is similar to CPI, except that it excludes things like rent and gasoline and probably food as things that tend to be more volatile as in inflationary cycles. It gets down more toward the core inflation numbers, which is what they like to target, because they figure that these other things are, as they like to say, transitory, but the core isn't as transitory. It tends to be sticky and it's hard to get rid of. And so that's the situation we're in for the economy. And I think that's pretty clear. The next rate increase will probably come in September. It'll probably be at least half a basis point, another 0.5% then at least. And it might be higher depending on how inflation goes between then. I think if inflation moderates a little bit, it'll just be a half. If it continues to grow, it might go a little higher. So that's to be seen. And of course, the Fed is basically taking a position, I think, that a recession is better than having this high inflation continue. And in fact, one may argue that high inflation rate will pretty much create a recession anyhow. That I'm not as sure about. I've seen people argue that, although I've seen periods historically where inflation was fairly high and it didn't immediately go into recession just because of that. Usually it goes into recession when the Fed starts increasing interest rates and people borrowing goes down and they run out of money. And anyway, so that's it's kind of a sad thing. It's going to be rough on some people. I hear that like food banks and things like that are already experiencing increasing demand. So some rough times are ahead here. And all this is interesting enough was probably unnecessary because they went off and spent a lot of money foolishly last year. And of course, the other issue that's came up, of course, is the recent decision of Senator Manchin to, I don't know if you say he reversed himself, but he made a deal with Schumer on a miniaturized version of the Build Back Better bill, which they're calling the Inflation Reduction Act. Speak of an Orwellian term, Inflation Reduction Act. And this thing involves raising spending by $433 billion estimated. Of course, that may not be what the final number ends up, maybe a little different, but at least that much, mostly on a variety of green energy projects. So I guess the payoff he got was a gas pipeline for West Virginia and maybe some additional leases on oil production or something. So he's cut a deal, and so right now what we're left with, I think, is what Senator Sinema decides to do. Apparently she was not in on the negotiation, and we don't know at this point what she's going to do. I'm of mixed minds. I tend to think she would go along with it. On the other hand, if she really wants to be the McCain of the Democrat Party, as I call it, what her strategy up to now, going against this would be an interesting decision. The other thing, by the way, is in the spending is also some kind of a plan to reduce prescription drugs. I suspect this has to do with Medicare, I think, but I'm not sure exactly how that is. Whether that means that Medicare will subsidize the prescription drug costs, or it's about trying to negotiate a tougher deal with the drug companies. I'm not sure exactly how they're going to implement that. But add to this is a big tax increase of estimated $734 billion, which is largely going to be on corporations. And essentially what this will do is that it will tax some of their earnings before they can take the various deductions that they're allowed to have under the current tax law. So it's kind of like an alternate minimum tax, if you know that term, for corporations, and with a 15% goal, minimum 15% of their top line number, I guess, of earnings. So that's I guess without the depreciation. I think that's the main thing. The details are still a little sketchy, but that's what I've been able to glean so far looking at it. The idea that this program will reduce inflation is a big joke. If inflation is reduced by other factors such as the Fed action, I guess then they can turn around and say, hey, see, we reduced it, our program reduced inflation, right? But that's not what reduced it. Actually, in practice, the kind of taxes, in theory, you could use taxes instead of increasing interest rates to fight inflation. But tax structures are far more inflexible, whereas the Fed can be far more flexible on managing the Fed funds rate. So That's one reason why it's not done, also because people tend to not like it when you raise their taxes, particularly for that purpose. However, this is not going to be a direct tax on people directly, so they get a pass on that. But what it will do is it will basically take away capital away from companies. And so effectively what it will do is it will basically be a tax on the supply side. And remember, that's one of the problems we have right now is the supply side, the bottlenecking and the flow of goods has been disrupted. You find goods you want not available. You have to substitute things and so forth. Cars are not available on the lot that you might want to buy or whatever. And the supply chain gets disrupted. Well, this is sort of at heart, if it has any impact at all, other than reducing corporate profits and therefore the value of people's 401ks and the like, as well as other portfolios, of course, it will tend to have the effect, I think, of diminishing job creation and expansion of the economy. Not necessarily the wisest thing to do when you're entering a recession, but that's the current plan, and we'll see whether or not they can get Sinema on board and everybody else can get over their COVID and vote this thing through. It's going to be done with reconciliation, so they only need the 50 Democrats, which is probably no Republicans voting for this, at least on the Senate side, and of course Vice President Harris will be the tie casting vote if that happens. That'll be interesting to see how that goes. It is interesting also to note that, of course, it's a reconciliation bill. So in that case, they will have a free-for-all for a period of time for people to submit amendments. So that's another thing that will be interesting. I'm also kind of curious, is there anything in this will run into problems with the parliamentarian, like with the last reconciliation bill that they were trying last year, the big $1.9 trillion bill. In reality, I think this is kind of a moderate statement by Manchin to kind of maybe pay for the obstruction he's done to a lot of Democrat programs, to kind of indicate, yes, I'm still on board with you and to help you out in this election, if in fact this really does help them in the election, which is also up in the air. At any rate, that's kind of what's afoot here in the latest economic news this week. It's kind of a lot of big news on that, and we'll have to wait and see. One of the interesting developments I've noticed in the political polls, I'll throw this in also briefly, is that in the Rasmussen poll, which is one of the ones I tend to follow quite carefully, Biden's approval numbers have climbed up from 39% to 45% during the week, which leaves me with a perplexed as to why that would be the case. I mean, has he done anything good during the week anybody liked? Has there been any really good news during the week for him? So the best I can figure is, could this be a reaction to the January 6th unpaid political ad that the networks gave the Democrats last Thursday? I don't know. And would that be the reaction to the attacks on Trump, would be to increase your approval of Biden? Or is it something else, or is it purely a statistical fluke in one poll? No other poll I've seen has confirmed us yet. So one of them that came out had him at 42, and that one was also a likely voter poll. So they should be more compatible than some of the others that are just purely registered. So interesting. Anyway, I just throw that out as a little update from what I said in the last video. So we'll see what that leads to in the week ahead. I think the announcement of the recession may kind of be a countervailing effect on people's opinions, but we'll see. Well, at any rate, and by the way, as always, I want to mention that my various social media account, the addresses of them are in the description below. I post most frequently on, of course, Twitter, but I do post on the other ones. Certainly, I try to promote these videos on them. So I'll wrap this up for now, and until next time.